Good evening, everyone. Welcome to our Irvine Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you tonight. Excited to be able to bring to you some of this first-time homebuyer information. We're going to get started in just a minute. I want to allow all of our guests to join the session. I know we're getting started right here, right at the top of the hour. Just to give you some housekeeping information. So this is a very kind of interactive type session. So as I move through tonight's presentation, we really encourage our guests to ask questions. We'll do our best to answer those live on air so you can have a little bit more information as it pertains to home buying. We're really excited to bring this course to you. We get a chance to teach classes like this every week throughout the year. We do this usually with the UCI alum about 4 to 5 times a year. And we're really grateful for the partnership we have with UC Irvine. In fact, we've been in partnership with UC Irvine alumni for the last 5 years. So, really grateful for the opportunity to be able to partner and help provide outreach in financial services to our local communities that we serve across California. I know many of you are probably joining us from Orange County tonight, but we do service all across the country in lending products, specifically, obviously, a lot more on the West Coast. Just really quickly, a little bit about me. So I'm the branch manager for American Pacific Mortgage. We're based out of Northern California, but this is kind of our home base. And then we kind of service all of our local markets from this office. Everything we do is generally virtually with our clients. We do have brick and mortar offices across the country, but primarily we do work one-on-one with clients virtually. And I actually meet with clients as part of kind of my day-to-day, but I also teach classes like this throughout the year too. Now we specialize in first-time homebuyer programs, so that's why we teach these classes. And we're going to share with you a little bit about first-time home buying this evening. So let's just get right into it and kind of talk a little bit about talking points for this evening. So we're first of all going to look at the housing market. We're going to talk a little bit about what's it look like in the local Orange County market. I also want to spend some time looking at a buying versus renting analysis to see if we continue to go down the path of renting versus buying, what does that look like? We're going to spend some time reviewing credit. I want to give you some tips and some resources to help maybe get your credit in the best possible position. Also talk a little bit about student loans, how those can potentially have an impact on your qualifying. We'll then look at loan programs, everything from FHA loans through jumbo loans. We'll look at documentation for your home purchase. What items do I need to have as I prepare for this home buying journey? And then we'll look at down payment assistance programs. That seems to be one of our popular topics, especially for our California workshops. We'll look at some of the resources that are available to you as first-time buyers to help with things like down payment as well as closing costs. And then I want to wrap up tonight's discussion looking at looking at the process of buying a house. So what does it look like to be eligible, pre-approved? But how do we go through these different milestones and get to the finish line, which is giving keys to the home? In fact, we got a chance to make several calls to clients that actually got the keys to their homes today. And it's just really a great moment to be able to celebrate that with our buyers. And then finally, I want to kind of talk to you a little bit about a personal consultation. Like, what does it look like to build a home buying plan for you as we go on this journey towards home ownership? So tonight we're going to learn all of that fun stuff. Again, we really encourage like being interactive with us during tonight's presentation. You know, we try to answer all of those questions as we move through tonight's content. I hope there's a few things that you guys can take away on your journey towards home ownership. So let's talk a little bit about, what does it mean to buy a house, right? It's probably going to be one of the largest investments we're going to make in our upcoming financial futures. Like it's a big deal. And taking time out tonight to be able to kind of get a chance to really understand more about this process and the resources available to you is obviously super important. And with home buying, there's some great benefits that come along with that. So when we think about buying a house, we don't have to worry about a landlord that's going to start increasing our rents every year, every time we renew our lease. So we got a little bit more controlling of our destiny with the monthly payment. You can create wealth through the equity in the home. So as the home appreciates over time and I continue to pay down my balance, the difference in those two numbers is equity. We have the ability to be able to pass along the asset to our estate. And there still is some tax benefits, believe it or not, that come along with owning a home. There's still potential tax deductibility with home ownership. So a lot of great things in home ownership. And, it's something that I know many of our clients are exploring and just trying to figure out what their options look like. And I think before we get too far down the path, I think it's always great to kind of just get a chance to do kind of a comparison on basically our budget. Like, what does it look like to continue to rent versus what is it going to look like if I make this big decision to go out and decide to buy a house? So let's look at that buy versus rent analysis. So I just kind of started screen sharing with you guys the calculator, and let me just make sure that we're good there. And so let's kind of talk a little bit about this. And by the way, all the material that I share with you this evening, we're going to send out back to you via email tomorrow morning, including all the links that we have in our presentation deck. So let's talk about this. So what we're going to do is we're going to build a rental scenario versus if I continue to buy a rent, and versus buying, what is this going to look like for me? And so I'm going to plug in these numbers. We have some of them already kind of populated for us right now, which is, if we continue to rent at $2,500 a month, and then we assume that in our budget, we have a renter's insurance policy of $15. And let's say our rent is going to go up about 3% every year. Now, I know many of you joining tonight's session maybe have rent rates that are going up higher than that based upon the kind of current pace in the market, but let's just kind of put an average figure of 3%. And then what we do as we kind of move through this calculator, we go in and we say, okay, now let's look at my home purchase. What's the price of home that I'm looking to buy? Now, just for tonight's exercise, we put in 500,000. I do realize that maybe that's a little bit low if you're looking to buy out in Irvine or some areas. I know that's probably 700,000 or 800,000, but I just want to kind of give you the math and how we look at the calculation here. So if we take a $500,000 purchase price and the minimum down payment is going to be 3%. So 3% would be $15,000. Okay, so we plugged in the $15K down payment here. We're also going to assume the property taxes into our budget. Okay. And by the way, I just got a question. We are going to record tonight's presentation. So everything that we share this evening will be recorded. It'll be available on our YouTube channel tomorrow morning as well too. So, and in case you didn't hear it earlier, we are going to send out all the presentation material tomorrow morning as well too. Okay. All right. Great question. So let's look at this budget again. So we have the down payment. We're going to factor in property taxes. Generally, we're going to budget about 1.25% of the purchase price into the property tax calculation. Now, it does vary based upon where you're going to buy your house, but we're going to say 1.25 or $6,250 for this exercise that we're going through. We also want to factor in homeowners insurance. We're going to add in the maintenance costs of my home. So those all get kind of plugged into the what if scenario for the home purchase, right? And then we also want to take a look at the financing. Now, generally, as a first-time buyer, we're going to use a 30-year fixed mortgage because the reason why we choose that is one is all the first-time buyer programs that we offer are all on 30-year fixed mortgage terms. Secondly, when we think about buying a house, especially as first-time home buyers, we want more of a predictable payment. So when we think about adjustable rates, those aren't obviously going to give us that predictability in future payments because those potentially adjust at a certain period in time. So a 30-year fixed mortgage is really what we would recommend. And we're going to talk more about interest rates in just a bit because there's a little bit going on that even makes it less favorable to go the adjustable rate route. We're going to put an average interest rate here. Now I'm going to tick this up a little bit. The rates have been kind of jumping around between 6.1 to 6.5, but just as kind of a worst case scenario, I'm going to put in 6.5 for now. Origination charges, that's how much you'll spend in your closing costs under the financing section. So when you work with a lender like us at American Pacific Mortgage, you also have closing costs. The origination charges would be what the lender charges you for your financing. Origination charges will vary based upon how much you finance and ultimately what your purchase price looks like. Now, as an alum of UCI, as well as some of our other partnerships across the country, we do offer a discounted program. So you actually get your origination charges discounted by $750. So that's a really great savings there. Now, discount points are going to be what you can elect to pay as an additional closing costs to help bring down your interest rate. So as we're seeing here, we have a 6.5% rate. Let's say as I do my calculations, I would really love to be at a 6% rate, and the market's just not getting down to that level. So as a consumer, we can elect to pay some additional expenses to bring down that interest rate. And those are called points. Points are usually equivalent to 1% of the loan amount, and usually 1 point or 1% will help bring down that interest rate about 0.25%. So if I really want to get to a 6% rate, maybe I have to pay 2 points or 2% of my loan amount. Now, in this rate environment right now, we see points being selected often from clients. But one of the great things with first-time buyer programs, which you're going to learn a little bit more later on this evening, is those rates are really favorable on those programs, especially right now. which offer no point options. So that's something to kind of think a little bit about. And the next component to closing costs will be other settlement services. Those are going to be things in the category around escrow fees, title fees, some of the government fees like recording and transfer charges. Now, what I would just say is that when you think about closing costs, you want to probably budget maybe 2 to 3% of your purchase price for closing costs. Now, every transaction is going to look a little bit different because ultimately it's going to be dependent on what is negotiated with the seller. And then the last section is the other assumptions. So we're going to look at appreciation rates of the home. So we're going to say the home's going to appreciate about 3% per year. We're going to factor in us being in the house for 7 years. And then the selling cost is really important to look at because when you sell that home 7 years from now, we got to factor in how much it's going to cost us to sell the home. Now, one of the great things about being a buyer is that in California, when you use representation from a realtor, you're not responsible for paying their commissions. Those are actually paid for by the seller. Now, 7 years from now, when you sell your home, not only are you going to have to pay for the fees of your realtor that represents you as a seller, but now you're going to have to pay for those buyer fees. So don't have to worry about that now as a buyer, but eventually when we sell our home, that's something we'll have to factor in. We have the state and federal tax rate, and then we also have our savings rate. So that's all kind of computed in here. And then when we look at a comparison here, and let's first of all talk about payments, because the big kind of factor that our first-time buyers are having to kind of really process is the jump in going from rent, which in this scenario, you have rent of $2,500 a month. Our buy side is going to push us to $4,200 a month. So we're talking about a $1,700 jump. Now, at the same time, though, when we look at the total cost opportunity over 7 years, it still does save us $40,000 a year $40,000 over 7 years by buying versus renting. Now, how do I come up with that? Well, if we look at the tax savings, so potential tax interest deductibility, we look at the appreciation of our home versus, the rental side where we're just paying $2,500 a month, not really kind of going anywhere. The 7 years mark shows us that we can still make over $40,000 by buying, even in this kind of higher interest rate market. Now, everybody's situation is a little bit different. And when we look at different budget scenarios, and that's why we really encourage clients to get a chance to get connected with us for a home buying plan, just to kind of see what your scenario might look like for you. All right, a couple questions came in, and then we'll kind of move on to our next topic. But one question was my thoughts around kind of YouTube influencers and suggesting about a real estate crash in the year 2030. Okay. Haven't heard that crash. I mean, I think, when we think about the real estate market, interest rate market, usually we see 10-year cycles. And, I think everybody wants to have their own kind of, prognosis of what the market's going to look like and forecast. But I think in this market, we're dealing with a very dynamic and global economic market. And I don't necessarily think that anybody has quite of a read. There's probably a lot of people that want to guess the market, but at this point, it really is going to be dependent on what factors exist in the economy. Like, what are we dealing with right now? And so current circumstance, we're looking at the federal debt ceiling, which is some concerns around interest rates, and we're going to talk a little bit more about that in a second. But the housing market is going to have its ebbs and flows, and I think, as I mentioned to one buyer earlier today, everybody wants the perfect storm in home buying, right? And that perfect storm would be the lowest available interest rates and the lowest price of home. But the reality is we're probably not going to get that. And so was it great when people were buying at 2.5% interest rates? Absolutely. But at the same time, they were also paying for marked up homes that were overbid, and we had multiple offers. And instead of buying the house for $500,000 a list price, we had, bids going up to $550 or $600. So I think that's going to be a personal decision on when you ultimately buy as a first-time buyer. Some people feel like right now is the time to buy for them. Others feel like maybe it's a 1 or 2 year plan. And I think that's why coming to classes like this is going to help give you all the tools and resources you need to make a good financial decision whenever you feel like that point is the make sense move for you. So the housing market obviously is going to play a role in that. Since that particular guest asked a question about where we see the housing market, I think it's really important to look at it. What does it look like right now? And this is actually the first time I'm seeing this graphic that we put together, and it's and because we haven't taught a class in a few weeks, and it's interesting to see what we're seeing in the Orange County Irvine market, right? We're seeing home prices starting to come down a little bit. So, I mean, that's a bigger move than I would have suspected. I mean, so we're seeing about a 9% drop on the median price. Now, some of that can be cyclical. However, we are still now going into our spring, summer buying months, so that may flatten a little bit, but I do think that's a bit of an encouraging sign for our home buyers to see that, we're seeing a little bit of a downturn in the market. Now, at the same time, I think one of the challenges we are having out in the market is inventory levels. You see this median days on market, which is 32 days on market. So what that means is when a home goes on the market, it's on average staying on the market for 32 days. Honestly, still not a long time. So what it tells me is there's still high buyer demand, not a lot of options out there for first-time home buyers. Now, number of homes sold certainly has dropped year over year. Interest rates obviously fueling that. When we look at a snapshot of last year's interest rate versus where we're at today, there's some differences for sure. Now, just after about this time last year, we started now seeing interest rates vault up to the 5.5%, 6% level. And so this next screen kind of shows you what interest rates are doing, because interest rates will drive some of the buyer behaviors and what we're seeing out in the marketplace. And so this is a look back over the last 25 years of interest rates. And obviously you can see when we go back in the late 90s, interest rates almost actually right where they're at today. And so today's rate floating around 6.5% is a far cry from what we saw at the bottom of the market, where rates reached about 2.5%. And so this gray line right here represents the start of the pandemic. And we saw rates obviously crash in the Q2 of 2020, right? And then, we kind of bottom out at a 2.5% rate. And then we started to see things start to move in 22 and then really move in the mid part of 22. And you can see the swift move upwards. Why did that happen? Obviously, inflationary pressures on interest rates. The Federal Reserve increased the federal funds rate. And so we had that swift move in interest rates, and kind of overnight, we saw rates start rocketing up to 6.5%, 7%. In Q4 of 2022, we hit about 7.25% in interest rate. Now, luckily, as of today, we have seen interest rates kind of come down. We've been moving between 6.125 and 6.5%. I think it's still going to remain a bit of a choppy market with interest rates. Some of the forecasts that I'm getting in on interest rates says we're going to land in the high fives. So maybe the 5.75 range this year, but it's a very fluid economy right now. And, it's really kind of, it's all about the headlines. And, when SVB, had, the bank failure there, Signature Bank, you had First Republic Bank, those are putting pressures on the economy. Does also put some pressures on, does the Federal Reserve still continue on this pace for interest rate increases? The last rate increase we had was 0.25%. Much of that was expected, but it'll be interesting to see what the ongoing pace of rate increases look like for the Federal Reserve. But I do think from a mortgage interest rate perspective, we're probably going to see interest rates stay in that, hopefully that high fives, the low sixes range. And so just kind of right now, at least this week, we're kind of riding a little bit of a higher level of interest rates. Now, what goes into an interest rate? Because not all interest rates are the same for every client that's obtaining home financing. So there's a few things to kind of keep in mind in terms of like the characteristics of interest rates. So credit eligibility plays a big role. If I have a 740 credit score higher, usually I'm going to get the best available interest rates. My product that I'm going to select, how much I decide to finance. And we're going to talk a little bit about how that relates to loan programs in just a second. Down payment, the cost of maybe buying down my interest rate, taking advantage of those discount points. And of course, the kind of the term of the loan I want. So if I want a 30-year loan versus a 15-year loan, a 15-year loan is going to provide a lower interest rate, although it's not as low as it used to be, but maybe there's about a 0.25% difference there. Typically with our first-time buyers, you're going to be, utilizing a 30-year fixed mortgage. As we meet with clients, it's really our job to design the right home buying solution that works the best for you. And that's, really why our consultations are so important for our consumers. Now, credit, as you saw, was a big factor on the interest rate side of things. And so what we like to do in our workshops is kind of talk a little bit about credit, because I think there's a few misconceptions out there. And, you know, kind of just share with you some of the things that we hear from clients as we meet with them on a daily basis. But I first want to kind of talk a little bit about the FICO score calculation. One of the things I hear working with our buyers throughout the day is, you know, I know many of you on tonight's call have monitoring tools like Credit Karma or Experian, Equifax, TransUnion. All that's great. But what we don't know as consumers is there's different models to credit scoring, and that can also change your eligibility for different products. There's typically 3 models to credit scoring. There's the credit score model, there's auto, and mortgage, of course. And so mortgage is obviously what we're going to look at on the finance side, but on the consumer side, when you're seeing your Credit Karma score and it might be 780, that is a credit card score. So if we pull your mortgage score, it might be, you know, 740. And it's just because the risk modeling looks a little bit different. So let's look at the weighting on a FICO score calculation. And I know many of you during tonight's class know some of this stuff, but I want to kind of give you some tips in terms of kind of trying to maximize and better understand the overall weighting for the credit score. So 15% is going to be how long I've had credit. So the more mature my credit file is, the better my potential credit score could be. 20% is going to be how much new credit am I trying to obtain? So how many new accounts have I opened? But more importantly, how much credit am I trying to get access to? That also will be known as like a hard inquiry. Now, one of the nice things about our process is we start with a soft credit check. So that doesn't impact your credit score, whereas a hard inquiry could potentially impact your credit score. So just something just to kind of keep in mind as you're going through this home buying process with us. So we really want to limit the number of inquiries. Now, there is a credit rule in place for inquiries that says that once you've started your first inquiry, so if I apply for a mortgage, by the way, this is for mortgage and auto financing, but day one, if I have an inquiry today, now I have a 30-day window of time to apply with as many lenders as I want. And it's the equivalent of 1 credit inquiry hit to my credit score. Now, for the most part, you know, in designing finances, as long as we meet the eligibility requirements, we're going to start with that soft credit score. So that's not going to impact you, but there is those credit rules in place to protect you on those hard inquiries. 30% is going to be how much credit I have in use. That's also known as utilization, and that's going to affect your revolving credit. So if I have revolving balances of $5,000 and my credit limits are $10,000, now I'm at 50% utilization. Some of our clients may be running a little bit higher on utilization, maybe it's 80 or 90%. When we build credit plans for them, we really want to try to get them below 50% because that's kind of the next level. And then once we've gotten there and we've kind of settled down and now we have a little bit more savings, the next stop would be to at least get our utilization below 10%. So in my example, we take that $10,000 in limits, let's try to get those balances below $1,000. One way to better manage your utilization is to take a look at your billing cycle dates on your credit card. So every credit card you have has a cycle date. And why that's important is because when that cycle date ends, that's when your credit card issuer is going to send out all the balance and payment history to the credit bureaus. So one of the tips I want to give you guys tonight is that if you can manage your credit balances to pay them off or pay them down before the end of the billing cycle date, then you're going to get a better credit score that shows up on the credit bureau eventually when we pull your credit. So because if you're in the habit of paying on the due date, it's almost too late at that point to try to influence your credit score. So if I can get it done before the end of the billing cycle date, just a much better opportunity to get that higher credit score. And finally, payment history, which almost seems like kind of self-explanatory, right? As you've kind of showed those behaviors of how you pay your bills, you're going to have obviously a better score if you've paid on time payments. If there's been any past challenges, they're rated as 30-day late, 60-day late, and 90-day late. If you've had any, maybe late payments in the last year or 2 years, those are going to be the most impactful to your score. So as I get beyond those 2 years, then I should see, maybe since the last date of the last late payment, I should probably hopefully see some increase in my credit score. So let's say I got a late in October of 22. Now, fast forward, now we're here at November of 24. I'm outside of 2 years. So hopefully I'll see an impact in my credit score at that time. Now, every product that we offer as a lender has minimum credit scores. So you can see them on the screen here. We have the FHA minimums, conventional, our VA loans for our veterans that are served and eligible for that product has a 620 minimum score. And then we're going to talk a little bit about first-time buyer programs tonight too, but those have a minimum credit score of 640. One of the things, just as you're trying to maximize credit score, to keep in mind, if you haven't had credit for a long time, obviously that 15% is the length of credit. When you're looking at managing credit cards, you want to be careful that you don't close out credit cards, because when you close out a credit line, that is taking away from your availability with your utilization side of things, but it also hits your length of credit. So you want to be careful if you're doing balance transfers and you're closing out the old account, that you could negatively impact your score. So you want to just be mindful of that. And when we look at credit qualifying for our buyers, we always look at all three bureaus for qualifying. So we don't just look at one credit agency, we look at all three. So here's the example. If I have a 740 for my top score, 720 is my mid, 700 is my low score. When it comes to eligibility, we're going to look at the 720 score. Now that's for an individual borrower. But if I have a co-borrower and that co-borrower is 700, 680, and 660, now the middle score between both of us is 680. So that's the score we would use for qualifying purposes. So as we meet with clients, we kind of, educate them on, what should we do from a credit perspective to help maximize our credit score opportunities. And at the same time, maybe we have to, restructure financing because of maybe credit challenges for one borrower, but not the other. Okay, so I had a question around credit that came in from the audience. So how many different lines of credit do you recommend having? So, that's a tough one to kind of call, because everybody's situation's a little bit different. I think, it really comes down to how long you've had those credit lines in place. I think having 2 to 3 credit limits or credit lines in place, I think is a good number. I think that's manageable. It's hard for me to tell you just if you do this many, you'll have an optimized credit score. But I think 2 to 3 from my perspective is pretty manageable. And then, you have one to, for certain bills that you use, or, grocery shopping, whatever the case may be, your entertainment card. I think that's a smart way of doing it, and just being able to get yourself in a position where you feel like, hey, as I charge things on that credit card, I can manage to hopefully pay that down or pay it off before the end of the billing cycle date. So when it comes to some of the negative items on our credit, we just want to give you kind of this matrix to help you better understand how long it'll stay with your credit. But to my point earlier, like the negative credit items in the last 2 years are going to be the most impactful to your score. So as I get far away from that event, so if my event is, like I said, October of 22, when I get to November of 24, now I'm outside the 2 years. Now I got a little bit more improvement in my credit score. But this is how long these items will stay with you on your credit report. Now, there is some updates that are coming to the credit bureaus as it relates to medical collections. Hopefully this year, we're going to see medical collections not appearing on credit reports, which will be super useful for a lot of our clients that may have had their credit scores kind of pulled down because of medical collections. Question came in, which is a good one. What is a charge-off? And we have it kind of labeled here. Let me get back to the screen. So a charge-off is when a creditor deems the account uncollectible, and so they decide to write that off to a loss. So if I had a $5,000 American Express account and never got paid, then American Express says, okay, we don't think we can collect that. We're going to go ahead and charge that off. And with charge-offs, they're going to stay on your credit report for 7 years. So if you do have those, we certainly want to try to get those cleared, because that's generally going to give us a nice increase in our credit score. Okay, so student loans, let's talk a little bit about those, because that is just the reality of some of our first-time buyers that are looking to purchase. Maybe we have some debt, and we do understand that because of the CARES Act as part of the pandemic, all federal debt is in forbearance right now, but I believe in September we're going to have to start making payments. So here's how the rules work. So on a conventional loan, you have conventional and FHA loans. You have an income-based repayment amount that we will use if you are in fact in that type of repayment program. So IBR, income-based repayment, if you had that before the pandemic started, then that's the payment amount that we'll use for qualifying. Now, if you graduated inside the pandemic, so if you graduated in 21 or 22, we have to use either a newly payment amount that you've selected with the servicer, or we're going to have to use 1% of the total balances owed on the student loans for a conventional loan, 0.5% of the balances for an FHA loan. So, we deal with that on a regular basis, because student loans are just part of something we have to have discussions around with our buyers, but we have to make sure that the eligibility is in place to be able to service those loans as those debts become due, because even though there's zero payment today, there is going to be future payments. So we want to make sure that's not going to impact, affordability for our buyers. Now, if you're back in school, you have ongoing forbearance, whatever the case may be, even though you might be in a deferment or forbearance status, we still have to count a minimum payment for qualifying. Okay, I'm going to pause there for a second. Any questions on student loans that I can help answer for anyone? Okay. All right. And we can always backtrack a little bit. I know we've kind of covered a lot of topics here so far, but we can always do a backtrack here. We did have a question that came in. Is there any benefit if you have paid them off already? So I assume paying off a student loan, there really isn't. I mean, I think the benefit would be is that's just less debt that you would have that would have to count against you for qualifying, but there is no, uplift, I think, from a credit score perspective. One of the things that does come up, because the student loan obviously is an installment debt. One of the things that comes up and sometimes can in the short term bring your credit score down a little bit is if you pay off auto loans or personal loans. I've seen that those can kind of at times negatively impact the credit score. With personal loans, I think it's a good thing to note that what we do find, because I know personal loans online are pretty readily available, you want to be careful taking out personal loans, because personal loans can kind of drag down your credit score a little bit. So, the SoFis, the Upstarts, there's a bunch of different personal loan companies out there. You want to be careful that if you've taken those out in the last 12 to 24 months, that can kind of pull down your credit score a bit. Okay, so let's talk a little bit about loan programs. And these are kind of the 5 core programs that are offered. And there's a bunch of different kind of ways to structure loans within these programs. But as a first-time buyer perspective, I want to give you guys the most useful information that can help you in your decisioning process. And so let's talk a little bit about each one of these products. First of all, the conventional loans. So when we think about conventional loans, we're talking about Fannie Mae, Freddie Mac loans. So those are usually occupy about 60 to 70% of all originated loans across the country. And the way it works with Fannie Mae loans is there's a minimum down payment of 3% across the country. Now that goes up to a maximum loan amount of $726,200. And so that's what we call as the conforming limit amount. Now, California is a high cost of living area, as we all know. If you're in areas like Orange County, LA County, the Bay Area markets, the maximum loan amount for a conventional loan in those areas is $1,089,300. But when we go above a loan amount of $726,200, that minimum down payment now goes from 3% to 5%. And the reason for that is because that's now called a high balance loan. So let me just kind of back up again. So if you go above a $726,200 loan amount, the minimum down payment jumps from 3% to 5%, and that is called a high balance loan. So it's a great opportunity because, conventional loans add a little bit more flexibility for our buyers, but at the same time, that minimum payment will jump up a little bit. Or down payment, I should say. Next product is FHA loans. And by the way, I'm going to go back to conventional loans in our next slide, and we're going to talk more about mortgage insurance. But for FHA loans, the minimum down payment is 3.5%. And that's whether you're at the conforming limit or you're all the way up to the very top of high balance of $1,089,300. That's still a 3.5% down payment for FHA loans. Interest rates may look a little bit different as you go into the high balance space. But at the end of the day, that's still going to allow you that minimum down payment of 3.5%. So someone asked a question in the audience of just what's better? Should I put down 20% or should I put less? And so that's a question that comes up often from our clients that we work with. And I think everybody's situation's a little bit different. What we're going to learn a little bit more in just a few minutes is more around mortgage insurance, because I think there's a stigma out there that if I don't put 20% down, my mortgage insurance is going to be through the roof and I won't be able to afford my house. And I think what kind of perpetuates a little bit of that is a lot of the online calculators have just astronomical levels of mortgage insurance that don't necessarily add up to the actual financing. So I guess to kind of really answer that question, I think it's going to really depend on your situation. So as we customize a home buying program, we'll have to figure out if 20% down is the right number or not, but it's not a requirement. I think what we're trying to get to is like, really, what's your payment goal when we're designing your home financing options for you? Okay, VA loans, those are going to be for our veterans that have served. Those have a minimum down payment, no down payment at all required on the VA product. And those can go actually up to $1 million plus in loan amount. And so the VA loan's an awesome product. And we also, are skilled in that product as well to be able to help serve our veterans. When you put zero down on a VA loan, there is no mortgage insurance, which is really cool. But for the veteran, there may be a funding fee depending on their eligibility. And a funding fee for a first-time user is usually 2.5% to 2.4% of the overall first mortgage amount. Last two products are the USDA loan and the jumbo loan. And the USDA loan is going to be for our clients that are buying in like more rural areas. Not often this happens with some of our first-time buyers, but because there's not a lot of different rural communities depending on where you're going to be in California. A lot of our desert communities in Northern California, we have some rural populated areas in the foothills. But the USDA product is basically allowing a zero down payment option for those type of properties. It is geographical specific, so you have to buy in certain areas, and there also is pretty tight income limits based upon the household size. The last product is jumbo loans, and those are going to be for our clients that are looking to purchase and finance more than $1,089,300. So it doesn't happen often that first-time buyers are going to elect a jumbo product, but it does at times. The things to keep in mind with jumbo loans is they're going to be a little more strict from an underwriting guideline perspective, but the asset requirement can be a little more extensive. And the reason why that is because there's reserve requirements with a jumbo loan. So when we think about home buying, not only are we saving up for our down payment, for our closing costs, but the reserves are going to be assets that we have left behind after we've contributed that down payment and closing costs. Typically, it's going to be at least 12 months the equivalent of my monthly payment. So if I have a $7,000 mortgage payment, 12 months of reserves means I have to have $84,000 that's set aside beyond my down payment and my closing costs. So that can be a bit of a stretch for some of our first-time buyers, and we understand that. And so when we think about conventional and FHA loans, those tend to be better solutions for our buyers because they have less of a restrictive reserve requirement. Usually there is no reserve requirement. Okay, so a question came in: how do we qualify for an FHA loan or maybe an HFA loan? I think we have two acronyms we use. We have the HFA loan, which is the Housing Finance Agency. FHA is the Federal Housing Administration. We're going to talk about HFA a little bit later in tonight's class, so we can probably table that till later. That's the CalHFA product. But with the FHA loan, that goes through our normal qualifying process, which happens during a consultation. And we're going to talk more about consultations in just a bit. I want to kind of switch gears and talk with you about mortgage insurance. And I kind of alluded to this a little bit earlier, that some of the online calculators just don't have a really kind of favorable number for buyers, and it kind of shoots the payment up a little bit more than it actually really is. Mortgage insurance comes into play when we put less than 20% down on a conventional loan. Now, FHA loans are going to have mortgage insurance regardless if you put 20% down or not. So let's talk first, though, about conventional loans. So there's different payment options available for mortgage insurance with a conventional loan. You can pay it monthly, which most of our buyers do. 95% of our buyers do it that way. You can split the MI up. You can pay part of it monthly. You can pay part of it up front. There's single premium, where you completely buy out the mortgage insurance all up front. And then there's lender paid mortgage insurance. And with lender paid mortgage insurance, you're basically increasing the interest rate a little bit to completely buy out the mortgage insurance. Now, mortgage insurance, and I think this is where those online calculators are kind of a bit off for our buyers to see, because it's not calibrated based upon the client's profile, because MI is based upon credit score, down payment, and how much you finance. Also, debt to income ratio is taken into consideration a bit. But those three main factors will drive the cost of the premium for mortgage insurance. And so when we look at Zillow or Redfin or some of the other websites that have calculators, they're usually doing just kind of a blanket mortgage insurance premium, which doesn't factor in those components. Now, mortgage insurance has a cancellation option on conventional loans. So generally, when you have 2 years in that loan and 20 to 22% equity, you can potentially cancel the mortgage insurance. So let's look at the cost of mortgage insurance. So if we go down to this PMI example here at the bottom, so we have a $700,000 loan amount. We assume a credit score of 740, and if I'm putting 3% down, my PMI on that particular loan structure would be about $209 a month. So if you run that same calculator online, it's probably going to close to $350, $400 a month. So it's really not as expensive as you might think. Now, the more I put down and the higher my credit score is, the less that mortgage insurance can be. So there's different factors that we look at, and they're basically a percentage of the overall loan amount that lead us to this dollar amount of the 209. Now, with FHA loans, it's quite a bit different because there's two components to FHA mortgage insurance. There's monthly mortgage insurance and there's upfront mortgage insurance. Now, the upfront portion, which is 1.75% of your loan amount, that gets added into your loan amount. The monthly MI is a flat rate of 0.55% of your loan amount, and that is paid on a monthly basis. Now, with FHA mortgage insurance, we cannot cancel the mortgage insurance. You do have to keep it for the full duration of the loan, unless you decide to refinance and then, of course, move from an FHA loan to a conventional loan, and that, of course, would cancel the previous mortgage insurance premium. Now, FHA about a month and a half ago released changes to the MI factors. It used to be 0.85%. That's been brought down to 0.55. So it's making the FHA product a lot more attractive for buyers. And when we do that same example of taking the $700,000 loan amount, our mortgage insurance is higher, certainly because the factor is larger. In fact, it's $320 a month. But the add-on to FHA is that we also have the upfront mortgage insurance, which is $12,250. That gets added right onto your amount finance. So that can certainly make the FHA product a little bit more expensive. Now, when you look back at these numbers and you kind of say, hey, why would I go with FHA? Because it seems like it's a little bit more expensive in general. The reason why someone might select one product over the other can really kind of center back to like qualifying, because the guidelines for FHA and conventional loans will look a little bit different. So FHA is a little bit more lenient than we would see with conventional loans. And let me give you an example. So let's say I had a bankruptcy that was 3 years ago. For qualifying for the FHA loan, I would need 4 years. I'm sorry, for conventional, I need 4 years. But with FHA, I could still get financing with only 2 years out of my bankruptcy. Let's say I had, a couple 30-day lates on my student loans in the last 12 months. It would be a lot more difficult to get through a conventional product with those recent lates versus FHA would be completely okay with that. Or if maybe I have a higher debt to income ratio, which, by the way, you're going to learn a little bit more about tonight. FHA might have a little more flexibility than, say, a conventional loan. So all of those factors would lead up to maybe us wanting to kind of gravitate towards one product versus the other. Okay, now I want to kind of take us now from looking at products to now, as we're building this plan of home ownership, what does it look like in terms of some of the documentation I might need to provide as I'm getting ready to look at my options. So here's some of the documentation we'll need for a W-2 wage earner. So usually we'll need the last 2 years of W-2s, most recent 30-day pay stubs, and then we're going to verify the employment through written and verbal form. And then as a self-employed individual, that's going to look a little bit different, because usually as a self-employed individual, I'm filing taxes as a sole proprietor, which triggers a Schedule C, or maybe I'm an LLC, LLP, C Corp, S Corp, whatever the case may be. Those will require more documentation for the financing side of it. We'll also want to verify the business, make sure there's, something available online about the business, probably a CPA letter to verify how long we've been in business. So all those things are taken in consideration for self-employed borrowers. Now, a couple things I want to share with you around income and documentation, and some kind of misconceptions, if you will. So what we hear as we work with buyers is that, some some information out there says that, I have to have 2 years on my job in order to qualify for financing. So actually not the case. What we look for is 2 years of history of a combination of employment and or education. So for those of you that, graduate from UCI and maybe you're getting ready to start your careers right now, if you say you graduated in the fall and now you're out getting ready to start your job, if you got 4 years if you had 4 years of undergrad, maybe with an accounting degree, and now you're starting up your job working for Deloitte, you have the 4 years in undergrad. So that would satisfy the 2-year requirement. So that's kind of something that's a little bit of an unknown when it comes to, buyers' understanding of financing structure. Now, let's say you're switching jobs. Let's say you've been at Deloitte for 2 years now, but now you're going to switch jobs. You could still switch jobs and have a valid offer letter, and we can use that to determine your qualifying. So those are the kinds of things to think about when it comes to kind of seasoning or time on the job. Now, if you have dual employment, let's say you work for, maybe you're in the healthcare industry and you work for one clinic for 20 hours, another clinic for the 30 hours in your week, we do have to demonstrate that we work both jobs simultaneously for 2 years in that scenario. So we won't be able to kind of put the 1 year or 6 month requirement on it. It would just be that you have to show that you've been working on both jobs for 2 years. Now, if I say drive for Uber, I have a full-time job, but I also drive for Uber. If I want to count both sources of income, then I do have to show in that scenario that I've been on the job for 2 years. Now, any additional income that we're looking to include on our loan application has to be documented. So if I have a spouse that is not going to qualify or be a part of the application, then we can't count that spouse's income. If we have a room that we're renting out, for example, and most products are not going to allow you to use that room rental. There is some certain scenarios where we can do that, but especially with first-time buyer programs, which if you're looking at those as a scenario, we just wouldn't be able to use room rentals, either today's room income that you're getting or future room income. So those are kind of some of the things that kind of pop up when it comes to kind of designing home buying options for us. But we really want to kind of share with you some of the documentation that's needed. Now, kind of staying with income, we do look at a calculation called the debt to income ratio, and that kind of gives us an indication of qualifying for our buyers. And it's a really simple calculation. It takes into consideration your gross monthly income versus your outgoing expenses. And so the way we look at that is we take our pre-tax income, and we look at expenses like credit card expenses, personal loans, auto loans, and we basically use that comparison for the debt to income ratio. I'm going to show you what the formula looks like in just a second, but I think it's something we want to kind of look at as a qualifying tool, not necessarily an affordability tool. Because when we think about affordability, we're going to look at, all the other things that we want to consider, like you've got to look at maybe our entertainment expense, or we're looking at travel expense. And so those are conversations we're going to talk about during your consultation, because we want to design home buying options that are going to be affordable for you, but also sustainable long-term for you with owning a home. Okay, so let's look at that actual debt to income ratio calculation. So here it is. We have the principal and interest, the taxes, insurance on the home, which is noted right here. By the way, we love acronyms in the mortgage industry. So we're going to give you a bunch of them tonight. So principal and interest, taxes and insurance, PMI. So we already talked about that, private mortgage insurance, HOA, which is going to be homeowners association dues. So we see those in play when we buy a condo, maybe a townhouse. So let's assume that's $2,500 a month. And then we have other debts out here that accumulate to $500 per month. So now I know I have $3,000 in expenses. If my income's $8,500 a month, my debt to income ratio is about 35.2%. So one of the questions buyers will ask me as we go through consultations is, hey, Jason, what should my debt to income ratio look like? And, my answer to that always is, it really depends, because it depends on where you feel comfortable from a payment perspective. I will say, in working with all the first-time buyers that we do over the course of the year, most first-time buyers feel really comfortable around a 33 to a 36% debt to income ratio. But everybody's situation is a little bit different. I think that's where that conversation around affordability is really super important. Let's talk now about assets for your home purchase, and really more kind of what's the documentation might need to look like. And so when we think about our savings that we're trying to build up for our home purchase, we need to document where those funds come from, because we can't use any cash funds for a home purchase. So as long as we have that in a savings account, checking account, and we can validate the last 2 months of those statements, then those certainly funds can be used for the home purchase. Any large deposits or some transfers, those all have to be paper trail. That's just part of the process for home buying. Retirement accounts can be potentially used, like 401ks, 403bs, IRAs. You just want to talk to your tax advisor or your financial advisor before you make any moves on those accounts, because we don't want to create like a tax liability for yourself. We do understand that if you're going to take it out of your 401k, you're probably going to borrow against it. And that payment that you have on the 401k does not count against your debt to income ratio. So it wouldn't, impact your overall qualifying. Gift funds can be also used for a home purchase, and that's where a family member helps contribute funds towards our home purchase. There is no seasoning requirement for that, and we don't actually necessarily need to see what the origination of those assets are. So when we document a gift funds, we usually just need the gift letter, as long as the donor is going to transfer that money straight to escrow. If the donor is going to give you the money and just kind of transfer it into your account, then there's a little bit more documentation required, like proof of the donor's bank account, proof that you've received the asset, and then of course the gift letter. But assets and savings is always probably one of the biggest hurdles for first-time buyers. When we think about challenges for first-time home buyers in this market, it's usually around credit, because maybe I'm a bit overextended from a monthly payment perspective, or as I mentioned, just savings, trying to get my savings goals up high enough so I can, make a down payment. And as I work with first-time home buyers, trying to overcome those hurdles, it's certainly not easy, but it's certainly something we can get to. And I think a lot of buyers think that home buying is like a 2 or 3 year goal, but it can actually be more of a short-term goal. And so when we look at first-time buyer programs offered through the state, and for those of you that haven't heard, there is a state agency called CalHFA, which is the California Housing Finance Agency. It's designed to help low to moderate income households really achieve homeownership. And, this agency has been around for, I think, the last 60 years. And in the suite of CalHFA products, we're able to provide support for both down payment and closing costs for home buying. Now, many of you may have kind of been connected with CalHFA through a product that was launched on March 27th. That was called the California Dream for All program. You may have heard it in the news, had a lot of spotlight there. I was fortunate enough to be a part of the project team that helped launch that program. That was a very unique program that provided up to 20% of the sales price for home buying. Those funds in that program were completely reserved within 11 days. In fact, we were on a kind of a wrap-up call to give some feedback on that program because the funds went so quick. And that may be a program that is around maybe next year. We're going to be kind of waiting and seeing if we get more allocation of state funds. But if you have kind of heard about CalHFA through the California Dream product, that's probably where those dots are connected. But we'll definitely be letting our kind of audience members in our classes know if that program ever comes back. But I do want to kind of share with you what's available today, because there's some really incredible products offered through CalHFA to help eliminate those out-of-pocket expenses, or reduce them down at least. So the first program is the MyHome Assistance program. That can provide up to 3% of a sales price for a conventional loan, 3.5% for an FHA loan. So when we look back at our program highlights that we had earlier tonight, the minimum down payment is 3% for the conventional loan, 3.5% for the FHA. So that would help fill the void for those minimum down payments. What the MyHome product is, it's a low interest rate loan that's at 1%. And that 1% loan does not need to be paid back until you either decide to sell your home, or if you decide to refinance in the future. So it's a completely deferred loan. And at 1% interest rate in this interest rate market, it's a super low option. Now that's to help fulfill the down payment requirement. Now, the next program that's offered through the state is called the ZIP Assistance Program. ZIP stands for Zero Interest Program, because it truly is zero interest. And what it is, it's a zero interest program offered of up to 2% of the loan amount, 2 or 3% of the loan amount that can be used to help pay for closing costs. Now, the ZIP program is something that's available. The trade-off with the ZIP program, what we found is that it does elevate the cost of the interest rate for the first-time buyer. So it doesn't always necessarily make sense as a product fit for our buyers, but certainly something we can talk about. Let's look at some examples of how we apply the conventional loan CalHFA assistance program to help, kind of reduce down buyer closing costs and overall down payment. So if we bought a house for $700,000 and we did a conventional loan, the minimum down payment is 3%, as we know from our earlier conversation. So that's $21,000. When we also purchase the home, we have to save up for closing costs. So if I'm going to buy a home today without any first-time buyer assistance, I'm probably going to need anywhere between $35,000 to $42,000. That's a bit of a stretch for most of our first-time buyers. The average amount of savings for first-time buyers that we work with today is anywhere between $10,000 to $18,000. So that just wouldn't work in that scenario. However, when we look at using something like the CalHFA MyHome Assistance, now we have one of the areas needed in our home purchase to be able to be solved for, which is, or we have a solution for that, right? So we have the $21,000 can be covered through the MyHome Assistance program. So that would cover my down payment. And now I would just have to worry about my closing costs, which are anywhere between $14,000 to $21,000. Now, at the same time, we do have an option to elect the ZIP assistance program. However, we got that little bit of a trade-off with the interest rate to be able to maybe get 2 to 3% of our loan amount in additional assistance. So that now takes our scenario of having maybe $35,000 to $40,000 out of pocket. And maybe now it's bringing it down closer to maybe $8,000 to $12,000 out of pocket, maybe even less. And so those are ways that we can help kind of minimize the total out of pocket for a first-time buyer, because we do understand that it is tough as you're getting your financial footing together with your finances to just be able to figure out, like, how do I save $500 a month? How do I have enough built up to be able to put 10, 15, 20% down? It's just not always feasible for most of our first-time buyers. So the CalHFA has eligibility requirements. The minimum score is a 640 for an FHA loan, 680 for a conventional loan. We do look at the middle credit score for both borrowers, as we mentioned earlier. So we will take the lowest middle score for both borrowers. Debt to income ratio that we just talked about, 45 to 50%, depending on the type of product. The income qualifications are going to be based upon whoever is just on the application. So oftentimes with this program, we may have married individuals, but if only one of the parties decides to apply, that is the only income that we're looking at. And CalHFA looks at their income limits based upon 150% of the median income. I'm going to show you what those income limits look like in just a second, because they are quite lenient as opposed to other first-time buyer programs that are usually at 80% or less of the median income. Now, a first-time buyer is someone that hasn't owned in the last 3 years. And so if you maybe owned a home in 2015 and sold it in 2018, and now you've been renting ever since then, you still would be considered a first-time buyer. And the programs are eligible for a variety of different types of properties. So single-family homes, of course, condos, townhouses, even some of the below market homes that are available across California. Manufactured homes, we get a lot of calls on manufactured homes, but it's a little bit more difficult with manufactured homes because they have to be on land that's owned versus land that's leased, like if they're in like a mobile home park. Here's the income limits for CalHFA. So Orange County's 235, LA's 180. On June 1st, CalHFA will be updating these income limits. So they should be going up based upon the cost of living, I would imagine. Not sure exactly how far they're going to go up. But CalHFA is a great resource for first-time buyers. We're proud to be the #1 provider of CalHFA loans across the state. So, as I meet with clients on a daily basis, it's really a great tool and resource to help make homeownership that much more affordable for you. Okay, so now I want to kind of take us through, as we're kind of getting towards the end of tonight's class, I want to walk us through now the 6 steps of home buying. And I think this is a really great visual tool to really understand, where do I go from here in home buying? So the first step is pre-approval, and that's going to be the output of a consultation with us. And that's where, after we've designed your product, we issue a pre-approval certificate. And that's usually valid for 60 days, but we can always recertify your pre-approval anytime. The pre-approval is used to present to a seller that you're interested in their home, to show that your financing has been all validated. Step 2 is going to be house hunting. And I think we had a question that popped in that was answered by one of our team members. But ultimately the question was, when do I partner with a realtor? And this is when that would happen. Once we get the pre-approval completed, we'd encourage you to connect with a realtor. We have a preferred realtor of network of realtors across California. So whether you're looking in San Diego or San Francisco or Irvine, we have realtors that we trust in the process, and we can always get you connected. As you learned earlier, realtors are paid for by the seller. So we really encourage you to take advantage of that resource. I think it's a great way to make sure that you're, negotiating properly with a seller, getting all the inspections that are helping protect your investment. So I think it's a wise move. Now, step 3 is going to be entering escrow. So what does that mean? So that's when we have an accepted offer with a seller, and that starts usually a 30-day clock. It's called the escrow time period, and those escrow time periods can be sometimes shorter than 30 days. Sometimes it can be, 21 days. It really just depends on the situation and really what's negotiated with the seller. Now, we just had a question that popped in. I just want to answer that really quick. The pre-approval is good for 60 days. So in case you guys didn't hear that earlier. So yeah, pre-approval timeframe is good for 60. All right. So when we enter escrow, we are going to be expected to perform activities on our side as a buyer. Obviously, your financing is in place, but you are expected to make an earnest money deposit within 2 to 3 days of the accepted offer. And the earnest money deposit is usually 1 to 2% of your sales price. Now, within 24 hours of your accepted offer, we're going to give you a call to talk to you a little bit about next steps and schedule a follow-up consultation, because I want to meet with you to kind of design your financing, make sure you feel really good about how everything is kind of constructed. We're also going to order an appraisal of your house. Your realtor is going to order inspections of your home. And within 72 hours of that accepted offer, we're going to also issue to you disclosures on your financing. And those disclosures kind of highlight everything that we've reviewed during your consultation. Now, the earnest money deposit, as I mentioned, is 1 to 2% of your sales price that you're going to be putting into escrow. And it's kind of like a good faith investment in the transaction. It's basically showing the seller that you're serious about, this home, and it's putting that financial interest out there. Now, that earnest money deposit is protected by what we call as the contingency period. So the contingencies allow you in the first maybe 14 to 17 days to do like your due diligence on the house, to get the house appraised, to get the house inspected, and then get your loan approved. And while you're in that contingency period, the deposit is completely protected. Okay. Now, step 4 is going to be processing and underwriting. That's where we're doing all the administrative tasks during the process, verifying employment, of course, ordering your appraisal, having everything structured for the underwriter to be able to review everything. And at step 5, that's when that underwriting process takes place. The underwriter is now approving your loan. And once that loan approval is done, now we're about 3/4 of the way through the process. And at that time, we're going to also be at the end of our contingency period. And why that's important is because now we have to make a decision. As long as we've got our inspections that check out okay, we have an appraisal that looks good, and we have our loan approval, then we can basically remove our contingency. But when we do that, that does tell the seller that we're okay with everything. We want to finalize everything in the process. So you just want to make sure before you sign off on that contingency that you really feel good about the property. Okay, so that's step 5. And then at step 5, we're also going to issue to you a final closing disclosure. And that's going to give you a 3-day cooling off period before we get to the very final milestone, and that's called closing your loan. That's an exciting time. In fact, we have clients that are signing their final loan documents just as we're speaking on tonight's session. And what it is you're meeting with a notary public, and they're going through all of your documents. It takes about an hour to maybe an hour and a half. And those are all in-person signings, because everything up to that point can all be done electronic signature. Now, after that's done, those buyers are going to go to the bank tomorrow and then wire in their final funds for the amount owed for their home purchase. That money gets reconciled by an escrow team, and they also reconcile the funds that we wire in for the financing, including the first mortgage and then, of course, assistance programs. Once that money is all balanced, the escrow team will then transfer documents to the local county recorder's office, have those documents recorded. Usually it's the grant deed that transfers ownership to you, as well as a deed of trust. And that's the agreement to repay the loan. And so what happens after that point is that the recording confirmation comes back. And when we get that, that basically says, hey, everything has been transmitted, the transaction's finalized, and we get a chance to celebrate with you because now you become the official owner of the home. We were fortunate to be able to make calls to 5 families today that were able to get their keys to their home today. And that's like the best part of the process for us, to be able to celebrate along with you, because we understand this is a big deal. And it's something that you're obviously concerned about, nervous, anxious about, but we want to walk you through that buying experience. We try to make sure it's a high touch experience, so you feel really good about what you're kind of going through. But at the end of the day, once you get to the final finish line, obviously it's a very rewarding thing. Again, this is probably going to be one of the biggest investments that you make in your upcoming financial futures. And if you're ready to move forward in the process, you want to kind of understand more about your options. I think I had a few questions come in the chat. This is where we would probably begin, is with a consultation. And the consultation starts with completing an online application. We do that soft credit check. You upload proof of your income and assets, and then you schedule that session with us. That's about a 20 to 30 minute video call to help design that home buying plan. I think it's a great way to kind of set some goals and objectives for home buying, whether it's a 2-month goal or a 2-year goal. At least we can get some basic framework in place for home buying for you. Now, after leaving today's session, you have some follow-up questions. I really encourage you to schedule an introductory call with us. Myself or one of our team members will be able to answer some of those questions that maybe didn't get answered in tonight's workshop. Here is the consultation kind of framework. This is kind of what it looks like. Understanding where I want to buy, price points, budgeting, credit, types of products, walking you through the home buying process. And if all goes well, our output of that whole meeting that we do is your pre-approval and really kind of a roadmap to home ownership. Now, we have some great resources that are available to you. Our mobile app is a fantastic tool. It's available for download for both Apple and Android. What's really cool about the mobile app is you can not only start the process there, but you can run calculators. I can't tell you how many times that buyers over the weekend are running calculations on their phones and actually getting accurate figures that they can use to make a decision on home buying. Now, I know all of you attended tonight's class because of our fantastic partnership with UCI, and we're really proud of what we're doing with our alumni network in Orange County, and we have other alumni across the country that we work with. And if your friends, family, coworkers are part of these networks, we would love to have them join some of our classes. There are free classes that we provide across the country, but we also provide some of these discounts to similar organizations that we partner with. So as we kind of get to the end of tonight's class, I do want to thank you for joining us and getting a chance for us to share a little bit more about home buying with you. These classes are available, and our full class schedule is available at mortgageeducate.com. So we would encourage you that if you kind of like what you've heard tonight, invite a friend, family, or coworker to join one of these classes. We have some what I think are really good testimonials of buyers' experiences with us, a lot of which have come through our classes. So we encourage you to check out some of our reviews online. And we try to put good content out on our Instagram that is really going to help you in this buying process, whether it's updates on products, could be, scenarios that we're running into, or just really good useful information to help you in the buying process. So we'd encourage you to follow us at Meda Mortgage for any information we could pass along through Instagram. So with that said, we're at the very end of tonight's class. I do want to leave it open for some questions for the audience, and then we'll wrap up. I know we're a little bit over our time, so thanks for bearing with me here. So let's kind of dive into our questions. Our first question is, are you going to send the link for the presentation and consultation? Absolutely. So as a reminder, all of our presentation material will be sent out to you tomorrow morning. We all have your email, and then the recorded version will be available on our YouTube channel as well. We have all of our recorded classes that we've done, I think, for the last 4 or 5 years. They're all available on our YouTube channel, as well as some of our other good content for you. So let me answer a few more questions. And so another question came: is the USDA process longer than others? So no, I mean, the USDA process should look the exact same as other products. So whether it's a conventional loan, FHA, or USDA, it should be on average about a 30-day process. Some of the unique products, like we did just recently, the California Dream for All program that I talked about, that process lasts a little bit longer because we were, restrictive on some of the state processing times. But all in all, a normal loan process should be about 30 days. Okay, any other questions? Probably keeping everybody from their dinner here, so I apologize for being a little bit over tonight. All right, well, I think we're at the end there. So of course, if you didn't get your question answered tonight, or just have some follow-up items that you want us to review, please feel to reach out to us. All of my contact information is here. We do appreciate you spending time with us. We understand that